Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, June 1st, 2010. Markets saw a very whipsaw-like session in the euro-dollar pair. First, we had concerns that the Eurozone sovereign debt crisis will lead to considerable losses for the region's banks, which pushed the euro to a fresh 4-year low, moving below the 1.2150 area to test 1.2110 as our low for the session. The ECB said that banks in the Eurozone will suffer considerable losses this year and next, which could amount to an additional $195 billion in write-downs and weigh on banks' profitability. If that wasn't enough to upset risk sentiment in currency markets, we also had some weaker than expected news from China, and that two measures of Chinese manufacturing showed continued expansion, though at a slower pace for the month of May. It's a sign that the government's recent efforts to rein in an overheating economy are having an effect. It also signaled concerns that the global economy may be heading for a slowdown or even a double-dip recession. Some of those fears were allayed in New York trading as we had a strong report from the U.S. manufacturing sector and positive stocks in the New York morning session, which helped the euro to rally rather strongly from its slide overnight, pairing all of its overnight losses. Therefore, those investors or traders adding to shorts following the break of 1.2150 were likely short squeezed out of their positions. The 200 period moving average in the 1-hour chart held at 123.50, and that was our resistance for today, which is also near a month-long downward sloping trend line which acted as resistance. Zooming out to a 4-hour look of the pair, we could see this downward sloping trend line here and how we tested it in today's trading. We also see that this is the third time that the pair has tested this 1.2150 area in the last several weeks, so this is an important level of support to look out for. Therefore, we can see that with a horizontal level of support and a downward sloping level of resistance, we're in a bit of a triangle pattern, and so a break below here would cause further declines for the euro-dollar pair, while a break of this trend line may give the euro a bounce, perhaps to 1.25 or to test the 1.26 area here. The pound-dollar pair, meanwhile, surged above its resistance from last week and our highs from last week at the 1.46 level until it reached a high of 1.4722 in today's trading, which matched up rather nicely with our old support from May 11th, which now is acting as resistance. Today's move also moves us away from the sideways consolidation range we had seen between the 1.4250 and the 1.45 area between May 16th and May 28th, so it's a bit of a bullish sign for this pair. The catalyst for the move were reports that Prudential's planned $35.5 billion takeover of AIG's largest Asian life insurance unit had fallen apart. News of the initial deal had hurt sterling given the size of dollar purchases that were likely to be involved. The pound has declined strongly during the month of May, as the concerns over the Eurozone sovereign debt had traders and investors selling the pound as well due to its debt profile. However, the new UK government has made cutting its deficit its #1 priority, so that has helped to install some confidence for the country's bonds. So if we continue to see the pound moving higher, then our next level of resistance will be the psychologically important level of 1.50, which was also our highs here during this bit of consolidation that we'd seen early on in May. Taking a look at the euro against the pound, we saw a sharp move after we broke below support here around 84.40 until we reached low at 83.20. So this showed how the euro was weak in overnight trading, especially during the European session, while the pound had gained during that time. This is the lowest that the pair has been since December of 2008, as we move below our lows from the middle of 2009. Before we look at some more market highlights, let's take a look at some of the fundamental data, especially the U.S. data that helped stem some of the risk aversion we saw from overnight. The ISM manufacturing PMI fell to 59.7 in May from 60.4 in April, but that April reading had been a 6-year high, so despite the decline, the overall reading is one in which the manufacturing sector is still showing some strong momentum. In this index, a reading above 50 indicates expansion, while a reading below 50 would mean contraction. 16 of the 18 industries tracked showed growth in May. New orders and production sub-indexes stayed around their April levels, and employment increased to 59.8 from 58.5, a good sign for manufacturing hiring for the month. As you can see from the charts to the right, we've had very strong readings the last 3 months, and overall the manufacturing sector has been at the forefront of the U.S. recovery, and despite the slight decline in May, we're still at a high level of activity for the sector. During today's session, we also had two central bank decisions. The Reserve Bank of Australia held rates steady at 4.5%, its first pause in increasing rates since February. Since October of last year, the bank has upped its benchmark rate 6 times, totaling 1.5 percentage points or 150 basis points. In its statement, the bank said that those rate hikes represented a significant adjustment to monetary policy, but they did leave the prospect of return from the sidelines within a short period of time, saying policy is appropriate only for the near term. Taking a look at the hourly chart of the Australian dollar versus the US dollar, we could see that we had a slide downward during the overnight trading as we moved from our high of around 84.70 down to a low of 0.8280. However, as New York stocks were positive and we had the strong ISM manufacturing data, we did see a recovery in risk appetite, which helped the pair to limit some of the losses we had seen from overnight. We did find resistance at our 50 and 100 period moving averages, and we were trading below the 0.84 level as of 3 p.m. Eastern. That continues this bit of a downward slide we have seen in the pair the last two sessions. And if we zoom this pair out, we had a very strong slide in favor of the greenback in this pair, going back to the middle of May as the Eurozone debt crisis caused a flight away from risk. The Aussie dollar pair fell from 0.90 all the way down to 0.81, and we did see a bit of a rally in last week's trading, which was a 50% retracement of this full fall. So that level acted as resistance, and following our 3-session slide, we actually found some support at 23.6% retracement of this full move at 0.8290. In the second interest rate decision today, the Bank of Canada raised its benchmark interest rate by a quarter point to 0.5%, its first increase since the onset of the global recession. While activity in Canada was strong in the first quarter, prompting the rate increase, the statement was quite dovish and may not mean the start of a relentless campaign to crank rates higher. Quote from the statement, given the considerable uncertainty surrounding the outlook, any further reduction of monetary stimulus would have to be weighed carefully against domestic and global economic developments. That means that policymakers will look for signs of an easing of the tensions in the global capital markets before they embark on a full tightening campaign. The US dollar Canadian dollar pair traded in a choppy range today, staying mainly within the price range we saw in yesterday's Monday global session. We could see, heading back a couple of the last 5 sessions, that the Canadian dollar had been supported in anticipation of the rate hike, but now that we've had it and the Bank of Canada sounded rather dovish, we'll see if traders continue to push the pair downward or not. In late New York trading, for instance, oil was down more than 1%, which should pressure the Canadian dollar. As we've seen the last few weeks, how the pair move depends a lot on risk sentiment and investor sentiment. And with that sentiment still uneasy, a move in favor of the greenback would likely move to test the 1.07 level in this pair, our highs back here. And a look at our final pair, the dollar yen. We see some sideways trading, though we did set a new low at near 90.50, which was our low from Friday's session. But then we did recover those early losses and moved in favor of the greenback following the ISM manufacturing report and US stocks being positive. This low tested the 200 period moving average in the 1 hour time frame, and it also tested our old level of resistance, now turned support from the area here in May 21st through May 26th. So the fact that we bounced up from this level is a positive sign for the dollar in this pair. And of course, now our resistance is here on yesterday's session, yesterday's high around 91.60. So that's it for today's market highlights as well as fundamental releases. So let's take a look at the upcoming fundamental docket. Tonight at 7:50 p.m. Japan releases data on its monetary base, and at 9:30 we get Australia's GDP data for the first quarter. Overnight, Switzerland posts data on retail sales. The UK releases reports on its construction sector, new lending to individuals as well as mortgage approvals, while the Eurozone posts its producer price index. Tomorrow in the US, we get a measure of job cuts, reading on pending home sales, as well as a look at domestic vehicle sales. And that will wrap up today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.